Hello, welcome to everybody here and all of those who are joining us online. I'm Caroline Atkinson, a board member at Peterson. Very glad to have been asked to moderate this discussion, an important one about what's been happening to business fixed investment and doing business in America and what is the global economic outlook. We're joined by somebody whose path I crossed with when we were both working in the White House some time ago, Economist, the US Treasury's Eric von Nostrand. And Eric is the Assistant Secretary of Treasury for Economic Policy, the Chief Economist for Treasury Secretary Janet Yellen. So he leads the Treasury's research and analytical work, as well as on economics, as well as providing counsel to the Secretary. He had an illustrious career before joining Treasury, both in the private sector at BlackRock and also since Treasury, he was behind the ingenious idea of the price cap on oil, on Russian oil. So Eric has been involved in a lot of the issues since 2022 that have been faced by the Biden administration, and of course is anyway very interested in what happens to US economic developments and why. So he was going to talk to us about what has been going on with business and business investment in America, why, and what we can expect looking forward. And so I'd like with that to turn it over to Eric. Thank you very much.
Good morning, everyone. Thank you very much, Caroline, for that introduction and for taking your time to moderate the conversation. I'm honored to join you all here at Peterson, an institution that has certainly done as much as any to help policymakers and the public think through some of the thorniest questions of economic policy. I'm grateful to Adam for extending his welcome and to all of you for joining us both in person and online. As Caroline said, I'm privileged to lead Treasury's Office of Economic Policy within the Biden administration. Our team works to inform the administration's policymaking process with rigorous economic analysis and to help the Secretary understand the economic impact of our existing policies. Today, I'm excited to think through with all of you a topic of central importance to the US economy and to our administration's goals, the state of and outlook for American business investment. The Biden administration has promoted policies encouraging business investment because it's necessary to improve outcomes for American families in the long run. For a prosperous corporate sector to truly benefit families and workers, businesses must feel confident investing their profits to generate new jobs, opportunities, and innovations. And by recognizing the public sector's role in creating incentives to solve market failures in strategically important industries like clean technology and semiconductors, we can expand our economy's ability to produce in the long run, a strategy that Secretary Yellen, my boss, has called modern supply-side economics. Business investment has been surprisingly strong, I'll argue today, in the post-pandemic economy. Higher interest rates raise firms' borrowing costs and are typically expected to slow investment growth. Higher uncertainty around macroeconomic forecasts in the post-pandemic expansion should also have slowed investment. But instead, business investment has grown faster in the United States than before the pandemic. I'll begin by considering the post-pandemic performance of US private non-residential fixed investment, or hereafter business investment, against three counterfactuals: historical experience, forecasters' expectations, and international comparators. I'll show that US business investment has outperformed all three counterfactuals since the pandemic. The well-documented surge in construction of high-tech manufacturing facilities related to the public incentives in the CHIPS Act and the Inflation Reduction Act explain much of that outperformance, as I'll walk through today. But there's more to it than just those public incentives. I'll also explore evidence that global investors perceive abnormally high rates of return to US investment even outside those strategic sectors, as evidenced by the rise in entrepreneurship and the rise in foreign direct investment into the United States. But the contributions of CHIPS and the IRA to the investment boom are palpable. Finally, I'll consider the outlook for business investment going forward. Importantly, the tailwind from manufacturing construction that has driven so much of this outperformance cannot continue in perpetuity and may in fact become a drag on investment growth in the coming years as groundbreakings recede. But if incentives to invest in the clean energy and semiconductor space persists, investors' focus is likely to shift from building those factories to bringing them online and staffing them, creating upside for equipment and intellectual property investment. Any steps by the next administration to weaken these important incentives risk slowing investment growth and thereby undermining the important progress that American businesses have made expanding our productive capacity. Let me begin by considering the historical counterfactual. This figure shows business investment as a share of GDP since the COVID business cycle peak, that's the blue line, compared with the analogous period in the Great Recession, that's the orange line, and the average behavior in all US business cycles since the 70s, that's the dotted line. Typically, investment tends to fall as a percentage of GDP in a recession and to continue to contribute less well into the early recovery. This was especially the case in the Great Recession, when business investment as a percent of GDP fell by more than 2 percentage points. In recent years, though, the blue line, business investment has bucked that trend, remaining for most of the period at roughly the same share of GDP that it was at since before COVID, a better outcome than after every recession since 1980. Indeed, in this cycle, American businesses invested $625 billion more than if overall growth had been the same, but investment followed its usual historical pattern. That's basically the integral of the difference between the blue and orange curves, and is an estimate of how much less business investment there would be if investment followed conventional historical patterns over the period. The second benchmark is what economic forecasters expected for business investment growth earlier in the cycle and how that compared to the outcomes we've realized. Business investment has generally outpaced economists' conventional wisdom, as measured both by the consensus forecast they issued earlier in the cycle and by using conventional modeling tools. This figure shows actual calendar year growth in business investment for 22, 23, and 24. Those are the blue bars, compared with both pre-COVID forecasts, the red bars, from October 2019, the blue chip consensus, and post-COVID forecasts from October 22, the green bars. Realized investment has outpaced the pre-COVID and post-COVID forecasts. The pre-COVID forecasts reflect the expectation that a historically middling rate of business investment growth between 3 and 4% would persist in the years ahead. Of course, those forecasts were missed significantly during the pandemic and were beaten significantly in 2021 after the reopening. But even once aggregate growth normalized in 2022, investment has continued to rise at a pace significantly above the pre-COVID forecasts. The post-COVID forecasts, the green bars, reflected an environment where the Federal Reserve's interest rate hikes were well underway and markets expected persistently higher rates. This was when there were a lot of headlines about recession probability models in excess of 80%. Actual business investment growth has outperformed each of these forecasts from 2022 to 2024 to date. It's also useful to understand the mechanical logic that drove some of those forecasts. So what we're showing here is an implementation of a conventional accelerator model, which forecasts business investment by positing that the principal driver that businesses use to make investment decisions is their perception of returns in the economy, typically proxied by recent output growth. The blue line is actual business investment, year-over-year change, and the orange line is what would be implied from a conventional accelerator model. And what I want to highlight is that for most of the post-pandemic period from 22 to 24, due to the recent deceleration of output growth following that immediate post-pandemic jump, accelerator models generally expected a relatively quick deceleration of investment growth back to those historically middling levels of 3 to 4%. While actual business investment for most of the past 3 years outperformed those expectations significantly. A third benchmark comes from comparing the US experience to other advanced economies. Now, global challenges, including the upturn in inflation and the ensuing increase in global interest rates, impacted other advanced economies, albeit to varying degrees, but something has been markedly different with respect to American investment. It's widely recognized that aggregate US growth has run faster than that of other G7 economies, but as shown here, investment is an important contributor to that outcome. It's generally hard to get perfectly matching national accounts measures of real business investment across countries. But Sam from my team has worked very hard to get as close to matching the US business investment concept as we can. And there's a long footnote here explaining how we did it for any national accounts nerds in the room. But really, and this is generally robust to how you measure this, we've seen a markedly larger outperformance of US business investment relative to other advanced economies. Obviously, they face many other challenges. Our European partners have been closer to Russia's invasion of Ukraine and the ensuing energy shocks. But nonetheless, US outperformance is striking. This chart shows the same data in a time series form, which illustrates the persistence of the surge in business investment in the United States, while other advanced economies have seen more wobbly paths. I want to turn now, and this is the chart I really want to dwell on for a moment, to candidate explanations for the performance of business investment in the United States. And first, which is what this chart does, I want to spend a moment decomposing investment from an accounting perspective. The national accounts divide business investment into structures investment, basically construction, equipment investment, so physical capital expenditures outside construction, and intellectual property investment, including research and development, software, and other non-physical capital formation. This figure decomposes business investment growth along those lines, further dividing structures investment into construction for manufacturing specifically and for non-manufacturing construction. Now, what I want to highlight first is that over the past several decades, and I'm looking at the left bar, which focuses on the period from 1972 up until the Great Financial Crisis, and also in the pre-pandemic expansion from the GFC to up until, the full business cycle from the GFC through the pandemic recession and early recovery. What I want to highlight is on those two left bars, the composition of business investment growth looks by and large consistent. The change in growth has been driven by contributions from equipment investment and from IP investment, with a somewhat varying contribution from structures investment, principally outside the manufacturing sector. What I want to highlight is that since 2021, since the passage of the CHIPS Act and the Inflation Reduction Act, we've seen a rather different picture in the composition of business investment growth on the right panel. By and large, see the contributions of IP investment and equipment investment have largely been consistent with the historical average, but we have something new, which is a significant contribution from manufacturing structures, factory building, essentially. This is another way of viewing that chart that we've all seen many, many times over the past years, the hockey stick chart of manufacturing construction that has increased significantly since the CHIPS and IRA were passed. Here is one way of looking at that hockey stick chart. Jason Furman in particular has been very critical of overuse of this chart, so I won't show the headline manufacturing series at his direct request, but I'll show something that goes a little bit deeper, which is a decomposition of manufacturing construction by the type of investment that's done. And what I want to highlight here is that all that hockey stick performance, all that historical surge, is really coming from one category: computer, electronic, and electrical investment. Those conventional types of factory building in the other lighter colored series here are not really contributing in any significant way to the upturn. The upturn is coming from high-tech investment, and this category includes both semiconductors, as incentivized in the CHIPS Act, and many aspects of clean tech manufacturing, in particular electric vehicle batteries, which have contribute significantly to the upturn. Here again, I think some international context is helpful to identify the drivers of the shift. No harmonized data series provides a perfect comparison to the US concept of manufacturing construction, but comparable data indicators help unveil the recent trends. And here, like with business investment, we put a lot of work in to try to identify the closest concept to manufacturing construction in the rest of the G7. And the point I want to make is that largely, the uptick in the boom in manufacturing construction is perhaps unsurprisingly, given its drivers, essentially a uniquely American phenomenon. We haven't seen other rich countries generally see this kind of uptick since the pandemic. Australia actually appeared to have something similar to it earlier on, but that has come back down to earth over the past year or so. And that comparison, I think, just helps identify the importance of the public incentives to crowding in private capital in the clean tech and manufacturing space. So it's clear that the factory building boom explains a significant share of business investments outperformance since the pandemic. And it's clear that that boom reflects a surge in areas encouraged by the CHIPS and Science Act and the Inflation Reduction Act. But as we saw back in that figure illustrating the contributions to business investment growth, we're still seeing strong, and in some cases stronger than over the prior cycle, contributions from IP and equipment investment too. So, my hypothesis is that factory building alone can't be the whole story here, especially given the headwinds to investment that are coming from higher interest rates over this cycle in general. And I want to walk through a little bit of evidence of a broader perception of especially high returns to investing in the US that we think business investors are seeing. A theoretical gauge of this, I think what we're really looking for is a measure of the expectation of the returns that business investors globally are looking to get. And we don't have a direct series for estimating that. One place I like to start is with an estimate of the return to all private capital, which essentially looks at corporate profits, all returns to investment as a percentage of the capital stock over time. This is a slow-moving series and subject to many different methods of estimating it. But the point I'd make is that the returns to private capital over the post-pandemic period, and this only goes through 2023, but while they've softened a little bit in the post-pandemic years, are generally have persisted in being on the upper end of their historical trend, which to my mind is an argument that if business leaders are thinking about what sorts of returns are they going to earn from investment in the United States, to the extent they're extrapolating forward the high returns they've received in recent years, that hasn't been materially affected by the pandemic. Now, I think there are two pieces of evidence suggesting that business leaders expect those high returns to continue. The first is that more Americans are starting firms. The higher rate of startups suggests that more founders expect strong returns from starting businesses than otherwise. There's been a well-recognized and widely touted surge in applications to start new businesses since the pandemic, with over 19 million new applications since the end of 2020. The pace of new business applications has eased somewhat from its heights last year, as shown in these figures, but they're still remaining obviously well above the pre-COVID rate. The surge in business applications is so sharp that one could be forgiven for asking whether this is some methodological or mechanical post-pandemic bounce. But several pieces of recent research have suggested that this surge is real, and no well-supported alternative measurement explanation has been offered a few years into this trend. What I think is happening, and I'll walk through a little bit of the research, is that in the post-pandemic world, investors are seeing, or entrepreneurs are seeing higher returns than normal to start to deploying capital in the United States. One piece of evidence that it's not mechanical is that the surge is generally persistent over several different categories of business applications, which are the three presented here. The left chart is the main one you've probably seen, all new business applications. This does include a lot of sole proprietorships and things that might not fit our prevailing understanding of what a small business is. But the others, which are those that the census judges to have high propensity to pay wages in the middle, and those that have actually identified a start date on which they plan to start paying wages on the right, while smaller in level terms have seen similar surges. Second research from Haltewanger, Decker, and others have also showed that the surge is concentrated in industries that are especially well suited to a work-from-home environment, such as non-store retailers and professional, scientific, and technical services. Haltewanger and Decker also looked at the geographic distribution of applications and showed they were concentrated, interestingly, in donuts around urban centers, consistent with post-pandemic residential and workplace shifts, all of which reduces the probability in my mind that there's something spurious and non-economic in this data, despite the sharpness of the shock. A second piece of evidence that business leaders are perceiving higher than normal returns is the picture from inbound FDI over the post-pandemic period. During the prior expansion, FDI into the US generally comprised between 10 and 25% global FDI, but it spent much of the post-pandemic recovery above that range. More recently, it's settled back into the high end of the old range over the past year or so. But comparing this expansion's average value to what we saw in the previous cycle suggests that broadly enthusiasm for getting access to returns from U.S. economic growth remains high. I want to spend a moment before concluding on the distributional implications of strong U.S. business investment, with a particular focus on two elements that we've already discussed at an aggregated level: the investment surge in clean energy technologies associated with the Inflation Reduction Act and the increase in U.S. entrepreneurship. To begin with, on the geographical distribution of high-tech manufacturing industries, we've analyzed the geographic and socioeconomic distribution of announcements and projects that have come online in the clean energy space using data from the Clean Investment Monitor set up at MIT. Since the IRA passed, clean investments have been landing in more economically disadvantaged counties than investment typically does, those with below average wages, incomes, employment rates, and college graduation rates. This shows, for example, a histogram, the distribution of announced Clean Investment Monitor investments since the IRA was passed with respect to the median household income of the counties in which the groundbreakings were done. And the point here is that almost 80% of those investments are in counties that are below the aggregate overall median income. And you might ask, well, aren't most counties, I've often gotten a kind of threatened gotcha on this point, aren't most counties below the average median income of the United States? And I think that's true, but that's in some sense the point, is what we're going for here is a distribution across geography that is closer to equal weighted across counties than kind of a conventional understanding of where investment happens, just being concentrated in high productivity, richer areas. And this phenomenon is generally robust to a number of different measures of economic disadvantage. Almost 80% of the announcements are below the average median household income. Almost 90% are below the average college graduation rate, emphasizing, perhaps unsurprisingly, but importantly, that these factories aren't being started in the richest areas in the country. And that's an important distributional benefit to what we're seeing here. I also want to highlight on the something that I think has been underappreciated on the entrepreneurship side. We don't have good data yet on the specific demographics of the individuals that are filling out those business applications. But we have something that I think proxies it reasonably well, which is the current population survey's breakdown of self-employed workers. And importantly, the racial distribution in particular and the gender distribution of self-employed workers has become much more broadly distributed in the post-pandemic era. This is a time series of the Black share of self-employed workers, which, as you can see, in the last expansion started to pick up a little bit, but has increased significantly in the post-pandemic era. And aside from that, clear post-pandemic spike in 2021 is otherwise at an all-time high. And here's another visualization of the same point, just showing how the racial shares of self-employed workers have changed and illustrating that the more evening out of the shares across races has been pretty broad. The white share obviously has been disproportionate for decades, but Black, Asian, and Hispanic self-employed workers have seen significant increases. I want to conclude by talking a little bit about the outlook for business investment. We've seen that it's outperforming history, expectations, and that of our peer countries, but the outlook for the coming years remains uncertain. We have little historical precedent for the next phase of the clean energy and semiconductor investment spike we've seen to date. We can't expect the same abnormal growth in manufacturing construction that's been so important to investment in the recent past to persist, but we should expect new forms of investment as those factories come online. We try to stay out of the forecasting business in the administration, but Goldman Sachs argued this week that equipment investment is poised to boost business fixed investment by 2 percentage points next year as IRA and CHIPS factories that were groundbroken in recent years begin to come online. Goldman believes this effect will offset most of the drag from slower factory construction that we've seen in recent years. An important risk to that outlook, though, is the potential that the incentives for continued investment in the clean tech and semiconductor spaces are reduced under the next administration. These incentives are an important mechanism for encouraging more private investment, as we have seen in recent years. And any steps by the incoming Trump administration to weaken them threaten to undermine that progress. Financial markets largely expect interest rates to continue to fall over the course of the next year, unwinding one of the principal headwinds for business investment this cycle. And the policy landscape will surely impact the outlook as well. Tariffs, in particular, of the kind of broad and unstrategic sorts that have been proposed recently, have been shown to weigh on business investment pretty heavily. Goldman Sachs again found that the increased tariffs of 2019 weighed on investment by increasing firms' input costs, by baiting retaliatory tariffs against U.S. exports, and adding to broader policy uncertainty. Taken together, Goldman found that the 2019 tariff increases were associated with a 1% to 2% fall in total investment. Despite the near-term uncertainty, U.S. businesses have been persistently investing at historically robust rates since the pandemic, with more Americans starting businesses and global investors continuing to look to the United States. The high level of investment has grown and will continue to grow the capital stock, even if further growth and investment itself subsides, driving faster growth of the capital stock and therefore our potential output. There's much reason to be optimistic that the business sector's success growing our productive capacity in recent years will persist in the years ahead. With that, I'll pause and very happy to take your questions and chat with Caroline.
So thanks very much. Not quite sure what okay, great. I guess it's white noise, like if you're in a jury. So thanks very much, Eric. That was great. And I think very interesting for people to realize and think about the different pattern in investment. And I've got some questions to ask, and then people online or people in the audience may have a bit. We're finishing this at 9:45, just a reminder. So my first thought is, if we pull back a bit and talk about why is it that the government has been involved in subsidizing, offering tax credits, and so on to spur investment. One question is, obviously, was that really necessary given the other issues that were happening, the strength that was coming anyway? But another question is, what is the market failure that the government is seeking to address with the IRA Act? So maybe you want to talk about that a bit.
Sure, thank you. It's an important question. It's probably the central question as a matter of economics that animates what the administration has called the modern industrial strategy we've adopted over the course of this pandemic. And many others have unpacked this case more broadly, especially Brian Deese and Jake Sullivan. But the principal argument is that it's not just one market failure. It's more a broader recognition that as the global economic outlet has benefited tremendously from the post-World War II international order that has been led by the United States and other advanced economies, we've obviously seen that order produce historic reductions in poverty in emerging markets around the world globally. But also, as we've also seen as the global financial crisis and the COVID pandemic have laid bare, there are in fact some costs to that global order that the Washington consensus, if you will, needs to contend with. And there's a recognition that international order, that market distribution of goods and services, has in fact caused some externalities on American workers. It has created space for countries like China to use non-market practices to gain unfair advantages that disadvantage other countries. So there's more a paradigm to recognize that there have been market failures, and I'll talk about some specific ones in a moment, that the public sector has a role in resolving. So specifically, climate change, ultimate textbook market failure. Climate change brings negative externalities that individual actors and investors don't themselves internalize. So the state has a clear role to align the incentives of American investors with something, to ask them to internalize those costs. That's the basic logic behind things like carbon pricing in Europe or stick-based internalization of externalities, but also the incentives that we're using in the United States, carrot-based incentives to increase the return to private actors of the kinds of clean tech investments that are going to reduce those climate change-oriented expectations in the future. So I think the clean tech subsidies, the market failure logic is clear. In the absence of state action to bring the cost of climate change into private investors' calculus, we're going to get an inefficient outcome where everyone is worse off because we're suffering bigger physical risks from climate change than we otherwise would. I think the argument for things like the CHIPS Act and semiconductors is also a market failure, but it's of a different kind. And it's something that importantly really does respond to the way China has conducted investment broadly over the past couple decades, and to the importance from a national security and international perspective of the United States building up productive capacity in these industries. As you know, my colleagues, including Undersecretary Jay Shambaugh, have highlighted, China's non-market support for its clean tech industry in ways that are completely untethered from global demand, and even outside the clean tech industry, has created a concentration of supply chain risks in the United States and advanced economies that the COVID pandemic really laid bare. That, like climate change, is the sort of inefficient outcome that markets have failed to deliver. And I think that, the state has a role to avoid that inefficient outcome by aligning incentives in the United States to build up some of that supply chain diversification, which is the logic behind the CHIPS Act.
Thanks very much. We could have a big debate just on that.
That's a whole panel. Sorry, I went on.
Just on that topic. In particular, I think there's a puzzle as to why your first point about climate change has led, or given the first point on climate change, we somehow ended up disadvantaging the development of clean technology in China in particular. So anyway, that's thanks for laying out those market failures. I remember I was in the administration, the Obama administration, when Solyndra failed. So I think one always has to worry in the public sector about whether it will turn out that there are problems that become embarrassing. And on that note, I wanted to ask you a bit about, I'm sure you saw a rather critical piece in the Financial Times a couple of days ago about the delays that there have been in the projects that the administration, or that have been qualified, the big projects, 100 billion and more, and that some of those came because market conditions changed. Price of lithium fell, so one of the factories that was under construction became less attractive. And I wonder how much you see those risks to, you mentioned that construction is going to fall down, but how much do you see the risks of there being delays and problems because that initial push from tax credits or whatever may fall away?
Yeah, it's a great question, and we're very attuned to those risks, as I alluded. I think that's one of the bigger risks to the U.S. investment outlook in the next couple years is the recognition that for this modern industrial strategy to work, businesses have to have certainty around it. We saw this, and not to quote, get political, but we saw a set of Republican members of Congress recently write a letter to Speaker Johnson emphasizing that the importance of persistent and continuation of the incentives around clean energy that companies have used to make their investment decisions in recent years is important to help the companies continue to invest, to help them continue to get clarity around the outcomes from what they're doing. So we do think the persistence of these incentives as a policy matter is really important. Now, from an economist perspective, how do we think about those risks evolving? Look, it's certainly true that there have been delays. I would just observe as a consumer of policy news generally, I've never seen a public investment program that was not quickly followed by a lot of press chatter about the delays. And I'm not denying that they exist, but I also think that, given the size of the change that is happening here, we also have hard data on how much capital has moved. And one of the points I tried to emphasize in my remarks was that it's not just the kind of simple point that, the US hasn't built factories in the high-tech space in a significant way in 30 years, and now it is. So there's a little insignificant uptick. The size of capital that has moved is enough to explain most of the divergence of aggregate business investment from history. So we're talking about real money here. It's not a little blip that's being highlighted for communications purposes. So I think that this is something real to the amount of capital that's going in has already made a significant contribution to growing the capital stock, even if the growth in that does fall off. And to be clear, we shouldn't forecast under kind of any policy outcome the abnormally high levels of business fixed investment growth we've seen over recent years to persist. No one thinks that hockey stick chart is going to keep going hockey stick because it reflects groundbreakings. It doesn't reflect the general equilibrium of ongoing investment, of ongoing operation of these factories that we expect.
Thanks. I want to turn to something else that was kind of underlying a lot of your comments, I think, which is actually, the voters may not agree, but the US has been a great place to invest. The US economy is doing really well. The US economy grew much more rapidly in the post-COVID time than expected by forecasters, than compared to international competitors or peers or whatever. And a lot of that, of course, was driven by consumption and somewhat by government spending. But the unemployment stayed low. And in that context, I think maybe it helps to be interested in your reaction. There's maybe that performance, which after all we also see in relative stock market moves, explains a lot of the increase in business investment. And it's not surprising that business investment as a share of GDP did not stay depressed after this recession in the way that it did after previous ones, or especially after the global financial crisis, because growth was better. So you saw an earlier, stronger recovery. So maybe there's not such a puzzle there with your orange and blue lines as one might have thought. And maybe the fact of forecasters being wrong about business investment was also, they were wrong about many things. They were wrong about what was happening. And so many, as you mentioned, projections of recession. So perhaps there are other things, and obviously one clear advantage that the US has is innovation and high tech, the AI developments and so on. Maybe that has been the major force driving investment, which doesn't really matter what it is that's driving it in a sense, but I wonder how you react to that.
Yeah, I think those are all good points. I think, generally we shouldn't talk about business investment growth and aggregate output growth as if they're two independent things. Right. The former is obviously a significant component of the latter. So it's in some sense, they're endogenous. The growth has surprised to the upside in a meaningful way. What I want to illustrate here is that business investment has been a big contributor to that surprise. It's not all kind of a consumption narrative. And in fact, I didn't show these charts, but you remember the chart I showed of forecaster expectations for BFI for business investment? Yeah. If you do the same thing, and this was actually a comment I got at Treasury, was, well, doesn't that just reflect the growth surprise? If you make the same chart with respect to GDP, you'll have to trust me on this for now, but I'll send the chart over. You see the same qualitative pattern, which is significant upside surprises to both the pre and post-COVID shocks, but it's actually quantitatively smaller than what we've seen in business investment. So one could, speculatively still, but I would argue, my hypothesis is that there's a disproportionate contribution of investment to the story here. what I think on your point about that first chart about the share of GDP, so I think that what that conclusively demonstrates is there's something different about investments, something better about investments' contribution to growth this cycle than others. But I think the best criticism of that chart is the criticism that, I'm comparing the COVID recession to every other historical recession. And I think the best criticism is that COVID's stop and start nature is not actually comparable to the other kinds of recessions in the sample in that chart. It's not that there was some bubble popped and the Fed tightened and then things normalized and we crawled out of it. We turned the economy off and turned it back on. So in some sense, it's unfair to expect all those historical patterns to persist. And I think that's probably the best criticism of the first chart. But I do think it's a factual matter, the idea that investment is playing a bigger role in the growth surprise than might be out there in the popular narrative, which has focused so much on consumption. That's something I think is clear in the numbers.
Right. Well, of course, consumption is so huge. I want to give a chance for other people, but one last point. When, and you focus quite rightly on spending on investment and so on, but when in the popular narrative, people talk about, and in fact, you mentioned it here as well, the impact on communities of the China shock, and popular narrative, when people talk about why we need to have what the market failure is and why it's good to get manufacturing back, there's implicitly or explicitly a focus on jobs and on employment. Oh. And of course, we know that US advanced manufacturing doesn't require many jobs. We also know that we've been close to full employment for a long time. And we also know that it's basically irreversible. As countries get richer, there's less employment in manufacturing, and that's basically fine. In 2020, there was between 8 and 10% of the workforce in manufacturing, and over 90% in services, and very few in agriculture. 100 years earlier, most Americans were working in agriculture. So can you just comment on the sort of disconnect which I think there is between, yes, investment may be going up, but no, that may not bring many more jobs. And maybe that's fine, maybe it's not.
Yeah, I'd put just the tiniest of asterisks on your premise before I go to it directly, which is I don't think it's as simple as this is all being done for, literally maximizing employment in any particular sector. This is all being done for maximizing output and welfare of American families. And we could debate what exactly the right utility function to measure is, but it's definitely more than just the number of Americans employed in manufacturing. The reason that, where we view from a national accounts perspective, we view these market failures we started our conversation with as reducing potential GDP. And these investments are meant to undo that negative shock by adding to our global productivity. I don't think there's any illusion that, that investments in clean tech, which, for all the factors you cited, are going to be less human capital intensive than, concepts of American manufacturing from decades past. I don't think there's any illusion that the number of Americans employed in manufacturing is going to look like what it did decades ago. But I do think there is slack due to the communities that have been left behind in places in the United States that have historically depended on manufacturing to harness some of this investment in growing productivity in the long run. So when I'm measuring theoretically in 10, 20 years, when we really assess the impact of this shift, I don't think counting those jobs is going to be the right metric. I think it's going to be, what happened to the real incomes of those families that benefited from these kinds of investments generally, both inside and out of the sector. Did we avoid the threats to our potential growth from letting these market failures go unabated, whether those market failures come from, the non-market practices of countries or from climate change.
Okay, thanks. So maybe time for one quick question. Joe Gagnon here, the mic, and...
Thank you. Joe Gagnon, Peterson Institute. I wonder, across countries, you showed U.S. invested a lot more business investment, and I'm wondering, guessing that's probably explains the better productivity growth in the U.S. You feel free to comment. My question is, of the three main things I think the administration has done, sort of the infrastructure, Build Back Better, the CHIPS Act, and the climate package. I'm not going to call it Inflation Reduction Act because it's a climate package. Can you just parse out for us how much of that hockey stick is due to each of those separately? Because it seems to me going forward, all of those may be difficult for the new administration to roll back, but the one that is most at risk would be the climate stuff. And how much of that hockey stick is, you think, driven by the climate stuff?
Yeah, it's a great question. And, I think, and this is why in response to Caroline's first question about market failures, I tried to kind of break up the answer across each of those. We didn't talk as much about infrastructure because I think the short answer with respect to infrastructure is that's a much longer term play for US productivity. I do think that will contribute in a significant way to crowding in private capital in the infrastructure space. But I don't think that's a significant contributor to the hockey stick chart. I think the hockey stick chart is mostly about the other two. And in that chart I showed that broke it down by type a little bit, that high-tech category, computer electronics, if you really get under the hood of that, which is not a trivial task because the census doesn't break it down further, but you can stitch data from some of MIT and some of the private sources that measure investments. And you see a significant contribution from the semiconductor groundbreakings. You also see a significant contribution from the clean tech space in general. In particular, what has manifested first is EV battery construction. That's also manifested in the press. You've seen a lot of headlines about the Hyundai plant and those generally. But quantitatively, I think I want to check the latest figures, but generally we've been thinking there's about 80 to 100 billion in EV battery investment generally, which is about I think in somewhere between 30 and 40% of the whole upturn in the hockey stick. So that is a very significant piece of it. Semiconductors are a real piece there. In terms of the policy landscape, I agree with you that based on the rhetoric of the incoming administration, it seems that the Inflation Reduction Act, the climate package, the climate stuff, if you will, is frankly under the biggest threat right now. And I think that's also the most important, where my answer for that on the market failure was more concise than the others, because that has such a much clearer logic, and that's why I think it's so important to.
Thanks very much. So please join me in thanking Eric. I think that was a very interesting discussion and very interesting to get all the charts as usual. Those will, I think, be displayed on Peterson website, and no doubt Treasury will be putting out information. So thank you very much.
Thank you all. Good to see you.